Hey SynthePulse community. So you've probably been wondering, is AI really going to replace Wall Street? And more importantly, can I get a slice of that algorithmic pie without needing a finance degree? For the last month, I decided to put my money where my tech curiosity is. I locked myself into a 30-day challenge. I handed $1,000 over to an advanced, highly touted AI stock trading bot review, sat back, and watched the magic or the disaster unfold. The tension was real. Did I end up sipping cocktails on a private beach, or am I eating ramen noodles for the next year? Let's find out. The setup. Choosing my algorithmic overlord. Before diving in, I had to choose the right bot. This wasn't just about picking the flashiest interface. It was about understanding the underlying logic. I spent a few days researching different platforms, those based on machine learning that predict trends versus those using high-frequency trading strategies. I needed something accessible but powerful enough to give me meaningful data. I settled on Synapse Trader 3.0. Let's call it that for privacy. Why Synapse? It uses sentiment analysis derived from global news feeds and social media, combined with classic technical indicators. I felt this provided a robust, multifaceted approach. My initial investment was a modest but painful to lose $1,000. This was my test capital, and my heart rate was already elevated. Defining the parameters, risk and time horizon. The first critical step was defining the boundaries. Trading bots are only as smart as the limits you give them. I set my risk tolerance to moderate high. I wanted growth, which means accepting volatility. My time horizon was purely the 30-day window, forcing short to mid-term trades. I specifically told the bot to avoid highly illiquid small caps and focus on the NASDAQ and NYSE blue chips, as the data quality for those is usually better. It's important to remember that this wasn't hands-off execution. It was hands-off execution, but hands-on oversight. I checked in daily, sometimes hourly, which was probably bad for my mental health, but great for research. Week 1, the AI honeymoon. Total bliss? The first few days were exhilarating. The bot started fast, making several small, quick profits. It was executing trades in milliseconds based on signals I wouldn't even have registered. On Tuesday, it bought into a semiconductor stock right before a major tech analyst upgrade hit the wires. Coincidence? Maybe, but the speed was undeniable. By Friday, my $1,000 had turned into $1,065, a 6.5% return in a week. If this kept up, I'd be rich in 3 months, right? This is the moment where the psychological danger of AI trading becomes apparent. The excitement of easy wins masks the underlying risk. I found myself questioning my previous manual investment decisions. Why waste time reading 10Ks when a bot can process the entire internet in real time? The hubris started to set in. This initial period reinforced the narrative that AI is a foolproof money machine. The interface was sleek, the numbers were green, and my confidence was high sky. Many experts agree that this early success phenomenon is common, reinforcing adoption. Week 2, hitting the volatility wall, the dip. Then came week 2, the reality check. The market decided to get choppy. My profits began to erode quickly. The AI, initially so confident, seemed to be flailing slightly. It entered a position based on positive sentiment, only for an unexpected inflation report to drop, causing the entire sector to sell off. My balance dipped below the initial $1,000 threshold to $980. This is where the psychological battle began. As a human, my instinct was to intervene, cut the losses, sell everything. But I had made a commitment to the 30-day test. I forced myself to trust the algorithm. Interestingly, the bot didn't panic. It initiated a dollar-cost averaging strategy on 2 falling positions, slowly buying more as the price dropped, betting on a technical bounce. Human emotion, fear, desire to save the remaining capital, impulse to take control. AI logic. Pure calculation of predetermined risk-reward ratios. Zero emotion. The result. By the end of week 2, the averaging strategy had stabilized the loss, bringing the portfolio back to $995. Still down, but the bot had prevented an emotional overreaction from turning a dip into a full rout. This was a powerful lesson in discipline. Week 3. The counterintuitive, high-stakes trade. Week 3 introduced the biggest tension point. The bot flagged a major pharmaceutical company, let's call it Biogen, which had recently suffered negative press regarding drug trial delays. Human investors were dumping the stock, yet the AI saw something deeper. Then came week 2, the reality check. The market decided to get choppy. My profits began to erode quickly. The AI, initially so confident, seemed to be flailing slightly. It entered a position based on positive sentiment, only for an unexpected inflation report to drop, causing the entire sector to sell off. My balance dipped below the initial $1,000 threshold to $980. This is where the psychological battle began. As a human, my instinct was to intervene, cut the losses, sell everything. But I had made a commitment to the 30-day test. I forced myself to trust the algorithm. Interestingly, the bot didn't panic. It initiated a dollar-cost averaging strategy on 2 falling positions, slowly buying more as the price dropped, betting on a technical bounce. Human emotion. Week 4, the final tally and risk management review. The final week was relatively calm. The bot shifted into a more defensive posture, taking profits on highly volatile assets and moving funds into stable ETFs, essentially locking in the gains. It understood the end of the 30-day period was approaching and prioritized preservation over aggressive growth. The crucial review was understanding the why. The bot's true strength wasn't luck. It was its ability to manage risk profiles dynamically. For example, it never allowed any single trade to expose more than 5% of the total capital, and it used trailing stop losses religiously, preventing minor corrections from becoming catastrophes. These are disciplines that human, emotional traders often fail to maintain. The final P&L reveal. Drumroll, please. After 30 days, the AI stock-picking bot took my initial $1,000 and turned it into $1,192.45. That's a net profit of $192 or 19.25% in just a month. Now, before you liquidate your 401k, remember that this was a high-risk, volatile month, and such performance is not typical or sustainable long-term without significant market luck. But the bot succeeded. It didn't make me rich, but it definitely didn't make me broke. It outperformed the S&P 500's performance over the same period by nearly 15 percentage points. The AI versus human equation. My honest takeaways. This experiment revealed that AI trading bots are fantastic tools, but they are far from being set-it-and-forget-it magic boxes. They excel at 3 things where humans fail. Speed, executing trades instantly based on incoming data streams. Discipline, sticking strictly to risk rules, stop losses, position sizing, regardless of market noise or emotional urges. Data synthesis, processing terabytes of news, charts, and data points simultaneously to find non-obvious correlations, where the human touch is still essential. So, does this mean human fund managers are doomed? Absolutely not. AI bots still lack crucial elements. Ethical or ESG filters. My bot didn't care if it was trading in morally questionable company, only if the stock was technically set to rise. A human investor brings values and long-term ethical considerations. Macro narrative strategy. Bots are great at short to mid-term tactical trades, but they struggle with predicting geopolitical shifts or truly understanding revolutionary, non-linear technological innovations, like predicting the rise of AI itself. The calibration. Crucially, a human still has to program the bot, define the risk, and select the fundamental strategy. The AI is the powerful driver, but the human is the GPS setting the destination. Conclusion. Smart automation, not blind trust. Testing this AI stock picking bot for 30 days was an incredible experience. The result, a solid 19.25% gain, shows the immense power of algorithmic trading. However, the biggest lesson wasn't the profit, it was the necessity of informed skepticism. These bots are incredible tools for automated execution and emotionless risk management, but they require a smart human pilot to set the course and monitor the journey. If you're considering using an AI bot, start small, understand the underlying strategy, and never invest money you cannot afford to lose. It's smart automation, not blind trust. So, that's my take on it. What do you think? Would you trust an AI with your investments? Which platforms scare you or excites you the most? I'd genuinely love to know. Drop a comment below. For more insights that decode the logic of AI, follow SynthePulse.